Hello everyone, welcome to CPA Exam Lab. Today we are going to review accounting changes and error corrections. This is one of the highest yield area of the CPA exam. You should definitely expect to get some questions from this topic. The good news is once you understand the framework, it is not that complicated. Let's get started. Okay. All right. ASC 250. This is the accounting standard that breaks into changes into 4 different categories. We're going to go each one of them more detailed, but as a quick overview, what are they? Change in accounting principle. This one, the most common example you can think of, maybe change in inventory valuation. Previously, they were using LIFO for their inventory valuation, and now they change it to FIFO, and they justify it. Here, what you need to look for is that in order to be considered change in accounting principle, they need to be both GAAP compliant. So what I mean by that, for example, an entity cannot say previously I'm using cash basis accounting and now I'm changing to accrual basis. This will not be change in accounting principle because cash basis is not GAAP compliant. Number 2 is changing reporting entity. This one, the most common example you can think of, maybe the consolidations or a subsidiaries. Maybe previously they were reporting with a subsidiary and they no longer do that, or vice versa. Number 3 is the change in accounting estimate. This area is huge. They love to ask questions from here. This one is basically we got new information and based on this we are changing our estimate. The most common example is depreciation. If there is a change in depreciation, this is considered an accounting estimate. This one they like to use as a trick question because a lot of the time students, when they see depreciation, they think it's related to accounting principle. But it is not, because depreciation in the end is an estimate. We are estimating the useful life of an asset. And then maybe later we decide that, or we got new information and we say, okay, it has more useful life or not. Number 4 is the correction of an error. This one is we just discover an error. Like it's as simple as you can put it, like something was wrong and how we are going to correct this one. As I said, you're going to go them one by one, but like you can see here, for change in accounting principle and the reporting entity, we go retrospectively. If there's a estimate change, we go prospectively. And if there's a correction of error, we restate it. You don't need to memorize yet. Now we're going to go one by one to make more sense. Let's start with change in accounting principle. Here is what you need to know here. The most important thing is we are switching from one GAAP method to another one. Basically, both of the methods were accepted. We are just choosing one over another. We are basically preferring one over another. And one other thing we need to remember here is that we can just not say, okay, I was doing LIFO and the next morning I got up and I decided to do FIFO. We need to justify it. How do you understand it? In the exam, you usually has questions like the company can justify the change. You can think of change in accounting principle. What are the most common examples? In the previous slide, I gave FIFO to LIFO or weighted average. That's the most common one. Or the for revenue, maybe previously the company was using the completed contract, and then later they change it to a percentage of completion and they're able to justify it. Or for investment, for example, they were previously using the cost method and now it is appropriate and they are using the equity method. They are all considered change in accounting principle. Here is the critical role. Like the previous slide, I gave the example, what happens if a company changes from cash method to accrual method. This would not be a change in principle. This would be considered an error because it was not a cash method, is not a GAAP compliant. When you make a principal change, use something called retrospective application. I like to think it as a time travel accounting. We are going back and we calculate everything as if we would always done this way. This one is done with 3 steps, and I'm going to give you an actual example in the next slides, but it is simple. Think of the earlier example I gave, the entities changing their inventory valuation methods from FIFO to weighted average. So how we would handle with retrospective application? Recalculate all prior periods using the new method, as if always this way. It's just the beginning of retained earnings. Very important, net of tax. We are definitely not touching income statement. This one is also asked almost in the simulations. They are giving you an example and you need to make a journal entry. There's an income statement there. You are not going to touch it. If there is a principal change, it is affecting the retained earnings and net of tax. The formula for the retained earnings adjustment. Unfortunately, for the CPA exam, there are certain things we need to memorize, and this is one of them. It is not complicated and the logic is simple. After a couple of examples, I think you will understand the logic. Basically, how do we calculate is that first we calculate the cumulative effect of the change, pre-tax. Then we multiply it 1 minus tax rate amount. Let's go with a couple examples. Let's say we had a principal change and that had a pre-tax effect of $100,000 and the tax rate was 30%. Using this formula, we got the cumulative effect, which was 100,000 multiplied by 1 minus the tax rate, 30%, which is going to be $70,000, which we are going to adjust the prior year retained earning by this amount. Now let's do an actual CPA exam question using this formula. Now to an actual example where it clicks. We have a Martinez Corporation. Previously they were using FIFO, but on January 4 they changed it to weighted average. And we need to calculate how much change we need to have on retained earnings. A couple other information about this question is that their inventory previously calculated as $850,000. If they did time travel accounting, which if they calculate their previous year using the new method, their inventory would be $790,000 and they have 25% tax rates. So if you remember the formula here, what we were doing, we were getting the pre-tax amount and that one was multiplied 1 minus the tax rate amount as 0.25. We calculate the pre-tax amount, which is the difference between the both method, 850 minus 790. We have $60,000 multiplied by 25. The decrease is going to be $45,000. Here I use the formula that was in the previous slides, or you can also calculate it this way. Calculate the difference in 160, then you calculate the tax effects, $15,000, and then you are looking at it, okay, did it increase or decrease? Because the inventory under weighted average is $790,000, which means previously we underestimated our cost of goods sold. So from this one you can see that it's decreased, or you can use the formula. Either way you see the same amount. Based on this tax, you need to decrease their previous retained earnings by $45,000. For the previous example, how do we do the journal entry? This is usually asked in the simulations. Always remember we are showing it net of tax. Like in the previous example, we had an inventory. The difference was $60,000. We reduce our retained earnings by $45,000, and we have a deferred tax asset of $50,000. This would be the entity's journal entry, the first day of the new year, where they chose the new method. Let's go over the exam traps that AICPA would like to put on us, because I know many of you probably also remember that you finish the exam, you think everything is good, you're going to pass it, then you end up failing because you probably fell one of those traps. Now let's go over them and hopefully you are not going to fall for them again. Number one is the non-GAAP to GAAP. So basically, if you see a question and in the question, it says like they are switching from the non-GAAP method to GAAP method. This is not a principal change. It is an error. Many see like examples like the cash basis change, the accrual basis. They think it is a principal change and make calculations for retained earnings. They don't get any points there. Number two is the depreciation method change. This is also a very big trap. This one we're gonna cover more detail on part 2, the next video. But in the example, if they are changing anything related to depreciation, this is not a principal change, it is an estimate. Number 3, like how would you differentiate what is estimate, what is principal? So if there's any information that caused the change, because estimate is based on the information we have. Sometimes an entity has certain information and they say, okay, based on this, we are expecting to make XYZ. But then later they have a more up-to-date information, so they are changing their estimate. So if you see anything that is related to information, it is an estimate. I do not think it's a principal change. Yes. If you see things like a preferable method, I don't know, maybe a company is getting into new contract and it is more preferred to use the new revenue recognition method. That is GAAP compliant and they prefer it and they justify it. You should think of a principle. Your freebie, because they also like to ask this one. If there is ever principal change, we have to disclose it. There is no exception to that. There is a disclosure requirements. What do we need to disclose? We need to disclose the nature of the change, what changed and when it occurred. We need to do a justification. We cannot say we prefer this method. There has to be a justification explaining why this new method is preferable over the old method. We have to disclose the effects on the financial statements, impact on income, EPS, and retained earnings. Their changes affected their cost of goods sold, and in their case, for example, they had to disclose their effect. And also we have to disclose the prior period information. So what the prior periods would have been under the new method. What I was calling earlier is the time travel accounting. Basically those four needs to be disclosed if you are making the change. Okay. Number 2 is the changing reporting entity. This one is not questioned much in the exam, less common one, so this is going to be more brief. This is related to structural changes. So the common examples, maybe there's a consolidation change, there's a consolidated group that's being added or removing a subsidiary. Then maybe there's some presentation changes, consolidated, now we present to unconsolidated or vice versa. Or a method change, maybe we were using the equity method previously, and now we are using consolidation. So here in the reporting changes, same as the principal change, if we see anything like that, we do retrospective. So in the exam, it is going to ask you, okay, there is going to be a reporting entity change, retrospective. If it's a principal change, retrospective. Those two, you can think that way. Okay, let's do another example. This was one of the CPA exam blueprint questions. You should expect to get at least a question like that on the exam. We have a Riverside Industries on January 1st to 6th. They changed their inventory method from LIFO to FIFO. And on the question, it is also saying us that Riverside can justify this change. Whenever there's a principal change, the company cannot say on its own, okay, I want to change it. They need to justify it. But on the question, they always say it. If they can justify it, most of the time they can think it is a principal change. And we have the following data is available. So in the old method LIFO, here they give us the numbers 320, 365, it changes. So the change is maybe 45. And the new method, they did the time travel accounting. They calculated the previous years, 345, 405, and then what it would be. So one other thing you need to pay attention here is that they make this change on the year 6, and they are giving us the two previous years information. They have a 30% tax rate, and it is asking how much adjustment they need to make beginning of the retained earnings. This is very similar question, the one we did earlier. I'm going to give you a couple seconds, and on the next slide, let's do it together. Let's do a quick review. Change in principal and change in entity. Overall, they are similar for both cases. We use retrospective adjustments. For both of them, we are adjusting the beginning retained earnings, net of tax. Their biggest difference is if there's a method change which is related to their preferability, this is a principal. And if related to structural change, it is an entity. On the next video, we are going to review estimates and errors. This video is 20 minutes. If you are not using the Pomodoro method, I highly recommend. It's after this video finishes. Just review it for a couple minutes, 4 minutes, 5 minutes. Then take a 5 minutes break and then go to the second video. So with the 25 minutes installments, you can both learn and you can also retain the information. See you on the next video.